One of our viewers asked this question: is the 2022 stock market correction over? We're going to explore if there's more pain or gain in the future, so stay tuned for the full episode. The headlines here says, Jamie Dimon says, brace yourself for an economic hurricane caused by the Fed and Ukraine war. Another stock market strategist sees stocks surging 15 to 25% from their May lows. So the question here is the correction over? Welcome back. This is Richard with Wisdom Investor. On this channel, we discuss Social Security, investing for retirement, saving your money for retirement, when to retire, and much more. Now today we're going to answer this question: is the stock market correction over? Is there going to be more pain or more gain? We're going to take a look at the current conditions, look at economic conditions, and what needs to happen in order for the market to move one way or the other. We're looking at the chart for the S&P 500 ETF SPY. This is a weekly chart. It goes back about 2 years. Year to date, the SPY has been down as much as 20% off the highs. Let's take a look at some other ETFs and see how they've fared so far in 2022. The SPY currently is down 13.3% year to date. The NASDAQ 100 QQQ is down 22.94%. Dow Jones Industrial is down 8.69%. Now it's not all bad. The XLU Utilities is actually up 4.56% year to date, and the XLE Energy ETF is up 62%. Now let's look at the NASDAQ 100 QQQ. Now the technology stocks have taken the biggest beating in this downturn so far. The NASDAQ 100 index has actually been down over 30% at one time. Let's take a look at the technology stocks and see what they've done year to date. You can see Apple, Microsoft, Amazon, Google are all down nearly 20%. Facebook's down 43%. Tesla down 28%. Shopify down 73%. Netflix down 67%. Here's the stocks with positive returns year to date for 2022. Johnson & Johnson up 4.41% and Coca-Cola up 7.09%. Those are the consumer staples. Energy stocks like Marathon and Exxon are up big on the year, as most energy stocks are. Here's some conservative mutual funds that I like. They all have a low percentage of stocks in their portfolio, anywhere between 20 and 38%. And you can see these funds have been down, but really very little damage is done. They're down anywhere between 6 and 7%. So that's a roundup of what's going on right now. We're going to look at some economic reasons why the market is down, and this will give us some clues on when the turnaround is going to happen. Individual stocks and index funds are reacting to the downside due to the changes in the U.S. and worldwide economic conditions. As everyone knows, we have high inflation. We have the Fed starting to increase interest rates. This is causing higher interest rates for mortgages and a possible slowdown in the housing market. Also, we have high gas prices right now, which is causing high shipping costs due to fuel costs, and that's causing all kinds of extra expenses for companies. Increased food costs, we have supply chain issues, and of course the Ukraine-Russia situation continues to evolve. Due to these economic factors worldwide, this is causing earnings and profits to be down for many companies. Earnings and profits will have to show signs of improving to see this market start to turn around. And with current economic conditions, is this going to happen? Are we going to see a turnaround? Is there a possibility of a recession? We're going to explore that right now. We're looking at a chart for crude oil. It goes back to 1980 all the way to 2022. Currently, the price of crude oil is running around $116 per barrel. Now, something to note on this chart. These gray areas are periods of recession. If we go all the way back to 1980, crude oil went up as high as $141 per barrel, and you can see what happened after that. We had a recession. Again, in 1990, crude oil skyrocketed. Around 2000, 1999, skyrocketed, and a recession followed. In 2008, crude oil was as high as $184 per barrel, and look what followed: a recession. Question is, are we going to see a recession this time? Past history says we will. We're looking at a chart of the federal funds rate. These are short-term interest rates. This is from Macro Trends here. Again, the gray areas are periods of recession. Had high inflation around the late 70s, 1980. Interest rates increased. Recession followed. You can see each time we peaked out in these interest rates, soon after that, recession followed. Now, we're just getting started on raising rates right now, but the question is, will we have a recession here? Now, this chart is very, very important. This shows the unemployment rate. Right now, we're hovering around the 3.5% area on unemployment. But you can see each time unemployment has spiked, inflation has followed. We haven't started rising on unemployment right now, but we're starting to hear a few companies start to lay off. And we've also seen a huge increase in food cost, anywhere between 6 to 14% on various items that we typically buy at the store. What needs to change to see the market move higher? We'll need to see signs inflation is starting to decelerate. Gas prices need to start to move lower. Unemployment needs to stay low, and the Ukraine-Russia differences need to be resolved. Now, I can pretty much tell you, if we get a resolution on the Ukraine-Russia situation, that's going to give us a big boost in the market. Let's go back to our original question. Is the stock market correction over? We're looking at the SPY again, the S&P 500 ETF, SPY. This goes all the way back to 2018. This is a weekly chart. We're going to look at some basics here. Anytime we're investing in the markets, we're going to have periods when the market's moving higher and periods when it moves lower. So that's a normal process here. Since 2018, SPY was around 220 and it's gotten as high as 440. That's a doubling of the S&P 500. That's 100% gain. So a pullback in the market is a normal process. At this point, if you've been invested over the last 5 or 10 years, this is just a minor pullback compared to the big picture. Now, if you've been a recent investor, as you started investing at the highs, of course, you're going to be concerned with your money. The other factor I like to think about too is if you're just now going into retirement and if you're having to withdraw some of your money as the markets are moving lower, that can cause a depletion of your funds much faster. So that's a big concern if your person is newly retired or close to retirement. Now, if a person's young in their 30s, this would be an excellent buying opportunity. As the market was moving up, we were saying on our channel here, wait till we get a big dip in the markets. Well, we're getting close to a big dip here right now. We're looking at the S&P 500 on a weekly chart here. It goes back about 2 years. The S&P 500 has been down as much as 20%. Recently, we got a bounce back up. So right here, we're basically what I'm calling an equilibrium area. When this was moving down, many times we get excessive selling and then we got to bounce back higher. So this is a point where the market is feeling like it's pretty fair value. Keep in mind, companies' earnings or profits are down, so it does make sense for the market to have moved down some at this point. Now, one thing we did not get when we had this bounce was the Fed saying they were going to start lowering interest rates. We didn't see gas prices come down. There really wasn't any of the economic situation changing. So we're still under the same economic conditions here. If we get more bad news, especially if it's unexpected, the market could very easily move lower. If the Ukraine-Russia situation is resolved, you can expect about a 20% rise. Due to the fact none of the economic conditions have changed and the Fed is still continuing to tighten the market and raise rates, I do not feel like this is the low in the markets yet. Can't tell you how low it could go, but it could go down here to 30% if the economic conditions worsen due to the inflation, rising costs of gas, food costs increase, supply strains, and more. We're looking at a chart for the S&P 500 again. This is back in the 2000 to 2008 stock market crash. On the right side was the financial stock market crash. On the left side was the dot-com bust. You can see the S&P 500 dip down here in early 2001. And then it had a push back higher. So we can get these moves lower and then get bounces back higher. Most of the time it stayed under this 65 period moving average on a weekly chart here. Now, how will we know that we're in a new bull market? I like to use this RSI 30 indicator here. You can see as the market was dropping, this red line here, you can see how the RS30 dropped below the midline, the 50 line, and it stayed there until buying started to increase in 2003. And you can see the RSI line staying above the midpoint line here. Then it dipped down again for the financial crisis. We went down, and then eventually we started to see a buying opportunity in the markets, and the market started a new bull. Under the current economic situation we're in right now, I don't see this as being the low in the markets at this point. With the high gas prices, high food costs, inflation increasing, interest rates increasing, I think there's enough that could potentially cause some issues down the road. So I want to thank you for watching here today. Stay tuned for our next update. Our scripture here for today is Proverbs 13:11. Wealth gained hastily will dwindle, but whoever gathers little by little will increase it.